if your household income is about 250K or between 400, maybe 600K or even seven figure, this video is for you because your 2025 tax return is about to look different and you need to understand how to make the changes work for you, right? Because we are talking about the big beautiful tax bill or the thing that was signed into law in July 2025 is brought the biggest adjustment for high income filer have since the 2017 Tax Cuts and Jobs Act. So in this video, we're going to break it all down into 8 parts. I know it's a lot, but we want to talk about the 25 tax landscape, the SALT cap, the AMT relief, the changes to child and education credit, the charitable giving and itemized deduction, some example for you how you can plan it, a checklist for you, especially the high income filer, and a quick summary for you, and then what's coming next. So we want to talk about next step after that. So if you're a business owner or dual income professional or simply someone with a higher household income who want to reduce your tax bill, you want to stay with me throughout this video because why each section kind of build on top of each other and your opportunity are new and exciting under the new law. So let's go with the basic, the foundation, right? What changes for a high income taxpayer in 2025? What did the big beautiful tax bill bring you, right? So we want to touch a different several parts for the big beautiful tax bill that will affect you in the middle and the upper income household, right? Why it also give you different kind of deduction and credit phase out. So 3 things matter most this year for you. First is the new SALT deduction cap. Second is the updated AMT threshold. And third is the new rule on credit and charitable deduction. So if you understand these things and you understand how they interact with each other, you can better plan for your 25 return. So you can save a lot of money and not wasting thousands of dollars on the table, right? I want to go a little bit deeper on the SALT changes on the deduction. So you remember under the old rules, you can only deduct it up to 10K in state and local tax SALT, right? So that cap hit high income household, especially in states like California, New York, and Hawaii, especially hard, right? So starting in 2025, the SALT deduction cap increased dramatically, like 4 times to $40,000 for married filing joint up. But if you are single or has a household or filing separately, sorry, it's 20K, right? Because the first time in year, many who were forced to take the standard deduction, now you can itemize again, right? Because especially if you have a lot of taxes, like property taxes. So remember, it's phased out at 500K if you marry jointly or 250K if you single, but the deduction never dropped before 10K. Let's give you a quick example so you can understand this better. So let's say a married couple in California pay 26K in state income tax, 14K in property tax, and that's 40K total, right? So under the old rule, you can only deduct 10K, but now you can deduct the whole 40K. So that means you can save maybe about 8 grand in federal taxes, like say if you are in the 20% bracket. So if you live in a high tax state, you want to make itemized deduction in 2025 if you could to save more, right? Let's talk about part 4, the alternative minimum tax or AMT. So AMT was originally created to make sure high earner pay at least a minimum amount of tax even after deductions. But in practice, it hit a lot of middle to upper income taxpayer unfairly. So the big beautiful tax bill make the system far more forgiving. So now what changes for you? So AMT exemption amounts phase out, threshold up of higher and index for inflation would mean every year it's going to increase a little bit to account for inflation. And the rate at which the exemption phase out now also reduced, meaning fewer people will get caught by it. What does it mean for you, 2025? The projected exemption amount are roughly 91K for single filer, 182K for married filing jointly, and the phase out start around 1.2 million for a single filer and 1.6 million for joint filer. In English, please, in another word, many professionals who were previously subject to AMT will no longer hold it. So this opens the door to planning strategy that used to trigger AMT, like you could exercising incentive stock option now, you can prepay property tax, or you can make larger charitable contribution, right? All these expenses have increased your itemized deduction. And now before you make any move, you still want your tax pro or CPA to run both regular and AMT calculation. But in most cases, AMT exposure is lower than it has been in years. If you are a parent, let's shift gear and talk about credit, especially the child tax credit and education credit. So let's start the child tax credit. It's a credit per qualifying child under age 17, increased slightly to 2,200 and also will be indexed for inflation. The phase out threshold remain roughly the same, so around 400K for joint filer, 200K for single tax filer. So if your income has grown, you still likely be eligible for at least part of the credit. Now for education credit like the American Opportunity Credit and the Lifetime Learning Credit, the income limit hasn't changed. Instead, the law added new compliance rules that take effect in 2026. To claim either of these credits, the taxpayer will now need to provide valid social security number for both the parent and the student, plus the school EIN. As part of the broader effort to prevent fraud and ensure that only legitimate students and educational institutions are claiming the benefits. For a family with dependent in college, this is your cue to get organized early, and you want to make sure you have the correct identifying information ready for this year filing. Now let's talk about charitable giving, an area where high-income taxpayers can still plan strategically. So the 60% of AGI limit for cash donations still remain in place for 25. But some good news for you, because donation make for qualified disaster relief as still 100% deductible. So if you are looking to reduce taxable income in high income year, consider timing your charitable contribution before December 31st. Another thing you can do is the donor advice fund, which is short for which is DAF. So this allows you to bundle several years worth of giving into one tax year to maximize your deduction, even if you spread the donation to charity over time. Say if you have been sitting on appreciated stock or crypto, you can donate them through ADF and also help avoid capital gain tax. So charitable planning remains one of the most effective levers for reducing AGI and staying under AMT and credit phase out threshold. Let's move on to an example that quick case study so we can tie this all together. This is our part 7. So let's say you are a married couple earning 600K and 25. You live in New Jersey and you pay 35K in combined property and state income tax. Say you donate 25K to charity and you can contribute 46K to your 401K. So here what your deduction would look like, right? So under the SALT deduction is 40K. So you add the full cap, you can deduct that. And then 25K charitable contribution, and then 10K mortgage interest. And then you are also under the AMT threshold, right? Still eligible for 2 full child tax credit, and you can reduce your federal tax bill by 20K compared to last year. So this example show you how you can, if you plan strategically, then you could take advantage of that, right? Let's talk about like a simple checklist for you. So we move into part 8, especially for high income taxpayer in 2025, what you can do before filing, right? You can verify all your sort deductions, so property, income, and local tax. You want to confirm your AMT exemption, and you want to test, like model it out to see how much you're exposed or not exposed. Max out your retirement contribution to reduce your AGI. You can review child tax credit. You can gather required document and education credit like SSN, EIN. Finalize on your charitable donation, or all your DAF have to be in by December 31st. Look at your itemized deduction, model it out, see if it's better than standard deduction. So with these stuff, like you are way ahead of many other people for the tax filing season. Let's wrap it up with a quick summary. So for high income household, the 25 tax return market turning point, the expanded SALT deduction, the higher AMT threshold, and the updated credit rule all work together to give you more flexibility and potentially more saving. What do you want to take away from all of this information, right? You want to plan early, you want to document everything, and you want to talk to your tax pro or CPA before you file. By modeling your number now, you can decide whether to accelerate deduction, defer income, or adjust retirement contribution before the year closes. So in next week's video, we'll talk about business extension and e-filing readiness, especially how to avoid the March 15 crunch and keep your return penalty-free under the new IRS rule. If you're a high income filer, you won't want to miss this one, because smart filing decision and March can set the tone for the rest of your tax year.